There are 9 economic indicators that professional forecasters watch to spot a recession before it officially happens. Right now, in 2026, some of them are perfectly calm, and others are flashing warning signs they've only shown right before every recession since the 1970s. This has split the forecasting community down the middle. Look at the data, and you'll find 2 completely different realities. On one side, data models put recession risk anywhere from a low 12 to 30%. On the other side, analysts are pointing to a cluster of early warning signals currently flashing red. The optimistic case rests on heavy, sustained investment in AI infrastructure, alongside strong spending from high-income households. This activity is doing a lot of the heavy lifting to keep those top-line growth numbers positive. But the cautious case looks at the foundation under those numbers. Multiple leading indicators, the specific data points that turn downward before the broader economy does, are aligned in a negative direction for the first time in years. This video tracks the data professionals use to filter out the noise and map out the real risks to your household finances. A recession is officially declared by the National Bureau of Economic Research, or NBER. The organization acts as a historian, confirming a downturn's start and end months after the facts are established. This timeline shows the problem with waiting for the official word. The NBER declaration typically comes 6 to 12 months after the economy has actually started shrinking. During that gap, companies are already cutting jobs, and markets are already reacting. If you wait for the news to tell you a recession has started, you've missed the window to prepare. That is why economists rely on leading indicators, metrics that shift months before the visible economy slows down. Waiting for the headline is a failed financial strategy. To protect your household, you need an early warning system built on these specific data points. We're going to track these metrics using a 9-point diagnostic scorecard, comparing the historical danger zones to exactly where the data sits right now in mid-2026. We start with the most famous early warning sign, the yield curve. It measures the difference in interest rates between 10-year and 2-year government bonds. This chart tracks that spread. Normally, long-term bonds pay more, but when investors expect weaker growth ahead, short-term rates spike higher. When this line dips below 0, it's called an inversion. The yield curve inverted in 2022 and stayed there for roughly 2 years. But as of mid-2026, it has uninverted. The line has crossed back up into positive territory, sitting at roughly plus 0.21. Here is why that matters. Historically, the recession doesn't hit while the curve is inverted. It tends to hit 3 to 6 months after it uninverts. That makes our current position highly sensitive. Our fourth indicator, the ISM PMI, tracks corporate purchasing and manufacturing health. It tells us if businesses are expanding or pulling back. A reading below 50 signals contraction. Sustained readings below 45 have preceded every recession since 1970. Right now, the data is hovering right on the edge of that danger territory. These heavyweights are highly reliable at signaling macro-level shifts in the business cycle, but relying on them to time your own household budget changes can leave you vulnerable to false starts. To get a clearer picture, we must look away from Wall Street and look at Main Street to see what consumers are actually doing. Indicator 5 is consumer confidence. A sharp drop of 20 points or more over 3 months is the historic red flag here, because pessimistic consumers cut spending, which directly slows the economy. Indicator 6 is housing starts. A steep drop in new residential construction often signals developers are expecting a broader pullback in buyer demand. Indicator 9 is GDP growth. By mid-2026, estimates project steady growth around 2.2%. It triggers a recession warning when the 3-month average unemployment rate rises 0.5% above its lowest point in the last 12 months. In 2026, unemployment has drifted up toward 4.5%, pushing the Sahm Rule reading to roughly 0.47. It is sitting fractions of a point below the historic trigger. Yet Indicator 3, initial unemployment claims, shows that actual weekly layoffs remain well within healthy territory, sitting around 220,000. To understand this contradiction, we check the earliest warning signs in labor, job openings, and temporary employment. Both of these indicators have fallen significantly from their peaks. Typically, companies cut temp workers and freeze open positions right before they start laying off permanent staff. This graph shows the anomaly we are living in right now. Both hiring and layoffs have fallen simultaneously to historic lows. This creates a frozen market. Usually when hiring drops, layoffs spike. Having both flatline at the bottom defies traditional economic models. Nobody is getting fired, but almost nobody is getting hired either. The practical trade-off for you is clear. You are highly likely to keep the job you currently have. But if you want to negotiate a major raise or jump to a new company, those doors are largely locked. Looking at the completed 9-point scorecard, the 2026 economy is firmly flashing a mixed yellow light. The yield curve and early labor signals are red, while coincident indicators remain green. This leaves you with a choice. Do you react to the red lights and pull back, or do you focus on prepared readiness and stay the course? Reacting aggressively is most dangerous for retail investors. Many see the yield curve uninvert and immediately move their money to cash to time the market. But financial markets price in recession fears long before the official NBER announcement arrives. Pulling your investments to cash based on leading indicators exposes you to a massive opportunity cost. If the economy achieves a soft landing, you miss the subsequent market rally entirely. Use this matrix to dial in personal risk. With high job security, tune out macro noise and maintain aggressive long-term investments. But if you're a contract worker, halt aggressive investing and focus entirely on building a 6-month liquid cash reserve. A cash reserve insulates you from a frozen hiring market. You don't need to predict a crash to prepare for a longer job hunt. Treat these 9 indicators as a diagnostic tool for your personal financial insurance. I'll update this list quarterly as data changes. Subscribe to stay ahead of the headlines. And if you want to know how to recession-proof your budget, that's next week's video.